Okay, let's unpack this. We're running the daily market briefing, and today is November 20th, 2025. And if you were looking at the charts, you see a market that just feels heavy, uncertain. Our mission today is to really get into the digital asset ecosystem and tackle what I think is the central theme, this complex divergence.
It's the ultimate push and pull, isn't it?
Yeah,
You have Bitcoin spot price, which is clearly struggling. It slipped below $92,000.
right. And yet at the same time, institutional infrastructure, the conviction, it's expanding at a pace that is, frankly, historic.
It is. It's the ultimate contradiction. You've got the flagship asset BTC showing real vulnerability. I mean, we had that clear rejection from the $100,000 level earlier this month. But then you look beneath the hood.
And that's where everything changes.
Completely. Corporate treasuries are making these multi-billion-dollar strategic moves, and the big traditional finance giants are launching brand new, sophisticated institutional products.
It genuinely feels like two completely separate markets operating at the same time. One is driven by, short-term sentiment.
And the other is all about long-term capital strategy.
Exactly. So today, we need to connect those threads. We're going to look at the confusing macro signal from the new jobs report, the huge ripple effects of Nvidia's earnings, and a strategic $2.6 billion bet that really defines the long-term thesis.
And to understand that short-term pressure, we really have to start with the fog hanging over the Federal Reserve.
This is where it gets really interesting, because the confusion in the market came directly from economic data that was delayed and then, contradictory. We finally got the September jobs report this morning.
And it gave everyone whiplash. Let's start with the headline number, the positive one. Non-farm payrolls. The U.S. added 119,000 jobs.
Wow, 119. That crushed expectations, right? Yeah. Consensus was, what, 50,000?
Around 50,000, yeah. And it confirmed a strong reversal from August, which was actually revised down to show a loss of about 4,000 jobs.
So strong hiring. That suggests the economy's robust, which historically is bearish for an asset like Bitcoin.
It is. A booming jobs market means the Fed has less reason to, ease monetary policy.
Less incentive for rate cuts.
Exactly. It reduces the urgency for them to consider aggressive cuts in December. They can stay hawkish or at least neutral for longer, and that pushes down risk asset valuations.
But you said there was a contradiction.
Here's the critical piece that created all the confusion: the unemployment rate.
Yeah.
It simultaneously rose to 4.4%.
Up from 4.3.
Right.
Okay, so hold on. We have more people getting jobs, but also a rising percentage of people who are looking for work and not finding it. Why does that matter to the Fed if NFP is so strong?
It matters because of labor market slack. Strong payrolls suggest momentum, absolutely. But that rising joblessness signals an underlying softness, an increasing slack in the labor market, and this contradictory data. It creates what we call stagflationary confusion for investors.
Stagflationary confusion.
The Fed gets conflicting signals. High employment might suggest inflation pressure, but the rising joblessness suggests, potential economic fragility. And that uncertainty contributed directly to Bitcoin slipping back below that $92,000 threshold.
Okay, so with that macro fog in place, let's talk technicals. The price action has been pretty sharp. BTC is trading right around 91,500. Where's the immediate resistance? And maybe more importantly, where's the ultimate safety net?
Well, the immediate fight is happening right now. 92,000 has clearly flipped to resistance. To stabilize, we need a really strong move to reclaim that 92.5 to 93.5 zone.
And if that doesn't hold?
If the macro pressure continues, the critical local support is down near 88,500.
And if we break that 88.5 level, that's when we start to risk exposing the structural foundation of institutional conviction.
Precisely. A break below that exposes the line in the sand that every analyst is tracking: $86,680.
86,680. That number has gained almost this mythological status. It represents the institutional cost basis, what they're calling the ETF realized price.
It has.
So for our listener who might know what realized price means for, say, miners, what exactly is the ETF realized price? Why is that 86,680 figure so critical.
Right. So the realized price metric calculates the average price at which all Bitcoins were last moved on-chain.
Okay.
The ETF realized price just applies that concept to the coins held by the major U.S. spot Bitcoin ETFs.
So it's the average entry price.
It's the average entry price for the hundreds of billions of institutional dollars that have flowed in through these regulated products. If the price breaks below that number, institutions are, on average, underwater.
And that tests their conviction.
It tests their conviction, and it can trigger some serious selling pressure. That is a level institutions are desperate to avoid crossing.
That puts the volatility in some serious context. Okay, let's pivot now completely to the growth side, because Bitcoin is still highly correlated to high beta tech. And Nvidia just reported a massive quarter.
Astounding is the word I'd use. Their Q3 results. They reported revenue of $57 billion.
$57 billion.
That's a 62% increase year over year, and it blew away expectations. Their guidance for Q4 is $65 billion. This isn't just growth. This is the acceleration of the entire AI industrial revolution.
A tidal wave of capital and confidence flowing into AI. So what's the specific physical crypto connection here, beyond just general risk-on appetite?
The connection is the hardware and the energy. Bitcoin, as that high beta tech proxy, sees its industry players benefit directly. We saw publicly traded Bitcoin miners companies like Cipher Mining, Iron, Bitfarms. Their stock prices jumped between 10 and 13% right after the earnings release.
Okay, that seems a bit counterintuitive. Why would Bitcoin miners surge based on AI chip sales?
It reflects a fundamental shift in how they're being valued. Investors are now looking at these companies not just for the Bitcoin they produce, but for their existing, scalable, and this is key energized data center capacity.
So they have the infrastructure ready to go.
They have it ready. As Nvidia's guidance suggests this exponential demand for AI computing power, these miners are seen as having ready-made infrastructure that can be pivoted or partially used for AI workloads.
It's a diversification strategy.
It's an effective one. It turns what was a single asset producer into a crucial energy infrastructure play.
That makes the whole industry far more resilient. But let's look at the immediate institutional flows, because earlier this week we saw a huge fear signal in the ETF market.
We did. Tuesday, November 18th, saw a record single-day outflow from BlackRock's IBIT, about $523 million.
A $500 million outflow. That's a massive capitulation event.
It is. When you see the largest and often most stable fund hemorrhage that much cash in one day, it indicates significant, localized institutional selling.
That kind of fear can trigger a panic. But did the bleeding continue?
And that is the pivotal piece of data that counters the fear narrative. Data from Wednesday the 19th shows an immediate constructive reversal. The entire spot ETF complex recorded net inflows of $75.5 million.
So it bounced right back.
It suggests the heavy Tuesday selling was indeed a localized event, a clearance mechanism, maybe a single large fund rotating or taking profits, but not a sign of sustained institutional flight.
Resilience. That's the key word here.
Yeah.
Nothing screams resilience and long-term commitment like MicroStrategy's latest move. This brings us right to the core of that divergence thesis we started with.
The $2.6 billion bet.
The $2.6 billion bet.
MicroStrategy, MSTR, is just continuing its incredibly aggressive corporate treasury strategy. They upsized their proposed convertible senior notes, offering from an already huge $1.75 billion.
To a staggering $2.6 billion. This is a critical integration point, right? Using these sophisticated tools from traditional debt markets to acquire digital assets.
It is. A $2.6 billion raise dedicated solely to buying more Bitcoin.
So let's break down the instrument itself. Why is a 0% convertible senior note so strategically clever?
It is financial engineering at its absolute best. It's a 0% coupon note due in 2029.
Meaning they're borrowing $2.6 billion in fiat at zero interest.
For 5 years. And on top of that, they structured the conversion premium at $672 per share. That's a 55% premium to the stock's current trading price.
So they are borrowing money for free, effectively at negative real rates.
Yeah.
And acquiring a scarce asset with it, while also betting their stock price will skyrocket beyond that 672 mark.
Exactly. They get zero-cost debt that is non-dilutive unless their stock achieves a spectacular rise. And the funds are explicitly earmarked for acquiring more Bitcoin. It's just an unwavering high-leverage conviction.
And what's been the impact of this strategy on MicroStrategy's standing in the traditional finance world?
This has successfully pushed MicroStrategy into the top 100 U.S. public companies by market capitalization.
That's not a crypto metric. That's a mainstream Wall Street measure of success.
It is. MSTR has fundamentally transitioned its profile from a software company to a significant institutionalized Bitcoin acquisition vehicle, and the broader market recognizes it.
That speaks volumes. But institutional interest isn't just limited to Bitcoin anymore, is it? We're seeing major players expand into the Layer 1 competition.
We are. We're seeing a race for market share. Fidelity just launched the Fidelity Solana Fund, FSOL.
One of the biggest names in asset management.
And this is a critical development. It gives their high net worth clients regulated exposure to another major asset outside of just BTC and ETH.
And they're joining established competitors in the Solana space like Bitwise and VanEck. What makes the Fidelity offering stand out?
The devil is in the details. The FSOL includes a staking feature, so the fund itself can generate yield.
Which is huge for institutional clients.
Incredibly attractive. And it offers a highly competitive management fee of just 0.25%. That's a clear shot across the bow to capture market share quickly.
And did it work?
Well, we saw $2.1 million flow into it on its very first day, so yes, there is strong immediate appetite.
So institutional players are building the rails for multiple assets, regardless of the daily price swings. The underlying infrastructure seems to be thriving.
It is thriving, and it's maturing. I mean, look at the institutional exchange layer. Bullish Exchange reported very strong Q3 results with record-adjusted revenue of $76.5 million. And critically, their focus on derivatives is paying off. They surpassed $1 billion in options trading volume.
That shows the market is deepening, providing those sophisticated hedging tools you see in mature financial markets.
That's right.
Okay, let's shift focus now to technological evolution and regulatory maturation. On the protocol momentum side, we saw StarkNet STRK surge 80% over the last 3 weeks. What fueled that vertical move?
That surge is a direct result of a strategic alignment with the biggest liquidity base in the entire space, Bitcoin.
How so?
StarkNet is integrating significant BTCI incentives and liquidity programs.
We should probably unpack that term, BTCI. What are the specific applications that are linking StarkNet to Bitcoin's liquidity?
Right. So BTC5 stands for Bitcoin Finance. It refers to all these different tech bridges and protocols that are designed to allow Bitcoin, the world's largest pool of digital capital, to be used as collateral or liquidity in DeFi environments on other chains.
So bringing Bitcoin's value onto other networks.
Exactly. For StarkNet, this means launching staking and liquidity programs specifically to attract wrapped or bridged BTC. It lets them tap into that, $1.8 trillion liquidity base to power their DeFi ecosystem, which drives demand for their native STRK token.
That fundamentally expands the addressable market for these Layer 2s. Now let's talk about the regulatory side, because the US, UK, and Australia imposed major joint sanctions this week. How does that affect the overall health of the asset class?
This is a crucial step for regulatory de-risking. The sanctions targeted Russian entities and individuals linked to the core infrastructure of cybercrime. By going after the providers of technical support, regulators are directly reducing the viability of crypto-denominated ransomware.
So tell us about the specific targets.
The sanctions went after Medialand LLC and the Aiza Group and an individual named Alexander Volosevic. These entities were infamous for providing what's called bulletproof hosting.
Bulletproof hosting.
Think of it as dedicated, highly resistant server infrastructure that allowed major ransomware gangs like Lockbit to operate their command and control servers without fear of being shut down.
So the action isn't targeting the crypto assets themselves, but the critical support structure that lets bad actors operate.
Precisely. By dismantling that foundational infrastructure, the hosting, the payment processors, the money laundering services, the barriers to entry and the operational risk for these groups just go up dramatically. It improves the overall security profile of the asset class and makes the environment safer for mainstream adoption.
So if we pull all of these different threads together, what's the ultimate conclusion for you, for the listener, processing today's divergence?
I think the synthesis is pretty clear. The market is definitely suffering from extreme short-term volatility. That's fueled by the mixed macro data from the jobs report and the dip below 92,000. But beneath all that volatility, the long-term structural supports are not just robust, they're aggressively expanding. You have MSTR making a multi-billion-dollar debt bet. You have AI integration stabilizing mining stocks, and you have these huge institutional product launches diversifying exposure.
It's the ultimate separation between the noise of the daily price chart and the signal of long-term strategic capital deployment.
Absolutely. The complexity lies in separating that short-term sentiment from the long-term capital deployment. Institution-driven growth, like the Fidelity Solana fund launch or MSTR's $2.6 billion debt offering, that's a story of infrastructure maturation. It's now operating on a completely different timeline than the daily price.
That's a great framework for defining the environment we're navigating right now.
And it raises an important question for you to consider as you process today's data. The fact that MicroStrategy, now a top 100 U.S. public company, is explicitly using traditional debt markets to acquire Bitcoin demonstrates a profound integration.
The silos are breaking down.
They are. So the question is, how much longer will traditional finance view debt, corporate treasuries, and digital assets as separate strategic silos? Especially given the aggressive and now highly successful integration strategy we've just seen executed, that relationship shift, that might be the ultimate signal of maturation for this entire asset class.